Good morning. I'm very happy to see you, and we are now starting our seminar, and the topic is very interesting: someone else's money. The industry has received a great incoming cash flow, and the prices have gone up finally. And of course, the main beneficiaries are oil companies, and the situation is getting better for them. At the same time, it's not as good as it looks. How to spend this money efficiently? Is the situation stable enough? What does it mean for all of us? What does increase in oil prices mean for other segments of the economy? All these are very relevant issues, and now we have our traditional guest with us, Jarand Rystad. He is the Managing Director of Rystad Energy. And now, Jarand.
Okay, thank you for the very nice presentation. And as you mentioned, this is actually the fifth time I'm here at IMEMO in typically November, in the late part of the year. Now it's October. And I'll actually start to review a little bit what I've said before. Because I think sometimes you should look back and when you are trying to say something about the oil market, which is very difficult. It's also useful from time to time to look back and look at what you have said and whether the understanding you have of the oil market makes some relevance for saying something about the future. So I will try to be honest. So basically, when the first time I was here back in 2014. And of course, also I do this because this will shed some light on my current presentation today also. So in 2014, we started to reflect upon what is really happening in America. And this was very early actually. In 2014, many people didn't really believe that the shale would reach levels like this. So this is directly from my slide, and then we claimed that the shale production, including the NGLs, however, would be 11 million barrels by 2020. And in between, we have had the oil price downturn, but it seems that this is what is going to happen actually if you include the NGLs. So, meaning that it has really delivered above expectations, the shale production in the US. And the consequence of that, as we mentioned, was that we expected an oil price decline to last shorter or longer, and we discussed the three different drivers of this. At that time, the oil price was still in the 80s, and many people expected it to fly back, but we saw that this also was a reason for Saudi Arabia. That's the lowest shock, to actually lower the price to see if they could stop shale from taking down the price very low, and whether that would cease all the drilling in the US. And as a consequence, we were looking at the market, and you see the heading here: oversupply 2014 to 2017, but the supply deficit after 2018. That was what we mentioned in 2014. But that was with a slightly higher oil price expectations, with $95 back in 2018 at that time. So we were a little bit we didn't see fully the cost compression to the extent that it fully happened. But we expected the base case was to see a supply deficit and a price increase in 2018. So, of course, which is pretty much what has happened. You see that from the curve. Okay, so 1 year later, I was here again in 2015. Then it was, as you remember, a very depressed market. And the global consensus was, many places at least, it was lower for longer. And even Shell published a report that was not named lower for longer, but lower for ever. And due to the shale, and that shale was able to come back at the low prices, the oil price would never go up again, was the perspective that quite some companies had At that time, we had the same observation that shale was continuing to have every year a higher production per well. So we see here the wells from 2008 up to 2015, and it was already tripled in productivity. And also the rate of pad drilling was increasing. So and then we made the oil market balance, basically looking at how much production would you have globally at the different prices. And to see something close to a global balance in 2018, we indicated that you needed $85, which was very much higher than the consensus of the oil market at that time in 2015. And the oil price was still going down. So we had this claim that the low oil price would be unsustainable after 2017. In 2016, that was another year with very low oil prices. And then we started to observe the value destruction for all the international oil companies. And then we had this heading that when will the international oil companies create value again? And what is value creation? Well, technically, it's higher return on invested capital than the cost of the capital. That is the definition of value creation. And we used different measures to look at that. We observed that the industry was returning like 3 or 4%, while the cost of capital was 8 or 9%. So basically it was value destruction big time. As you see here, we showed the typical weighted average cost of capital, and in 15 and 16, the return was respectively 5 and 4%, which is value destruction. But we indicated, and we looked at only 57 out of the 675 listed global oil companies did actually create value. So it was 92% of the companies destroyed value, and only 8% of the companies created value at that time. But the companies that actually did create value, that was the companies that were positioned in the Permian Basin in the US, and also some conglomerates and companies that were downstream integrated, and as an exception also quite some of the E&P companies in Norway that took the benefit of the growth in Norway, like the Norske, which is now named Aker BP, and Lundin, and also OMV, the Austrian company that was exposed for Barents Sea exploration. And we indicated that, yes, probably 2016 will be the bottom of the cycle, and you will see that the return on invested capital will come back. And then we predicted this to be about 8% for international companies in 2018. So that's also something we will look at quite soon. So, and also in the year 2008-16, it's a wrong heading here, we were presenting at ONS in the big conference in Stavanger just about the oil price. And then at that time, the oil price was $45. We have this electronic sign updated every 20 seconds in Stavanger and in Oslo. So people will recognize this. And at that time, we from putting in the global production into our UCube, now the global database, and looking at what prices we needed, we concluded that we would need $80 in 2018. That is 2018. That was what we said back in 2016. So in 2017, last year, then basically from having these very linear predictions of the oil price, basically just putting in an oil price into our model and see what we get, and then putting in another one and see what we get. What we have developed over the last year has been a system dynamics approach to the oil price, meaning that we are looking at every month, and then we're looking at what is the oil price as an input to that month, and what decisions will be taken that month, and what will then be the future supply-demand balance as a result of that. And this is then changing every month, and we have to do the full iteration every month. And then last year I showed you some of the first results from this simulation. And so just I wanted to model, to understand other commodity cycles as well, like the pork meat cycle that you see these graphics from 1927. So where we can see some of the same patterns in the oil market. So I showed this for you last year. At that time, you know, the oil price was more in the 50s, in the 60s, and we indicated that with the market we saw and with restriction of about 700,000 barrels, either from restricted shale or from some other, oil price could go up to 80s and stay flat there for 1 year. So, which is, as you have seen, pretty much exactly what has happened. This model we have continued to develop since then, and for those that are interested, we have white paper. We have a white paper that is available on our webpage without cost. So for those that want this, if you just we wrote a press release called "Can a Swing Producer Stabilize the Oil Market?" That was published 2 weeks ago. And you will find that under our press releases. And if you just Google, for example, Rystad and stabilizing, you will get right into this article and you can download this report. So I will not talk about that today, even if it's very interesting, of course, to talk about the system dynamics. What I will talk about is this picture, that global oil companies are back at record high cash flows. So it's actually $590 billion that is after investments available for the investors. Of course, you have to use this to pay dividend, to pay debt, and to do share buybacks. But still, this is a record high cash flow. It's even higher than in 2011 or 2008 when the oil price was peaking. So I wanted to say that this is the highest ever, but when we look in real terms, I must admit that actually if you go back to 1979 and 1980, maybe a few of you still remember those 2 years, that was even higher. So because then the oil price was really peaking, you know, following the wars in the Middle East and the situation in Iran at that time. So, but since 1979 and since 1980, this is the highest cash flow to the industry, both in nominal terms, of course, but also in real terms. And on top of this revenue, cash flow, it is investments of 530, so meaning that the operational cash flow is $1.12 trillion. But, however, since 1980, the industry as a whole has invested $10.7 trillion. So if you want a decent cash flow return on the gross investments, you should have 10%. And this is actually what you get. By the way, we see a similar strong cash flow for the next 3 years. So it is really payback time for the oil and gas companies. They are going to almost drown in cash over the next 4 years. However, if you look at this, 2/3 of this is national oil companies. So of course it's Aramco, it is Gazprom, it is Rosneft. Even if there's some other part of the companies is listed, we have included the national part of the companies here. But 1/3 is international oil companies, where we actually can invest and benefit as a private person as well. So this is 175 billion, and we will look into this in more detail. So this is about 150 companies. This is also about 150 national oil companies, but very dominated by a few very big ones. And this is the rest globally, which is more than 3,000 smaller companies. So this is the distribution of the cash. So let's then look at only these international oil companies. So this will be 3 segments: independents, and the independents are all the Apache, Anadarko, Devon, and the smaller companies, but still sizable. It's not startups; it's still sizable companies. And integrated companies, that is companies like Lukoil and Repsol and others that have also a downstream value chain. And majors, that is the global 7 majors globally. Exxon, Shell, Chevron, Eni, Total, ConocoPhillips, Yes, and Shell. So, and as we see, these companies are also seeing a record high cash flow. They haven't had as high cash flow since 1995, and I think as well here you have to go all the way back to 1980 to see higher cash flows. However, the independents have had a negative cash flow over the last from 2010 to 2015 because they invested a lot in the shale. I'll come back to that. And in 2015 it was negative cash flow for all of these companies, and this was before dividend payment. And the dividend payment is about 50 billion for these companies. So they have the burden of paying about 50 billion to the shareholders, and they also have share buyback and debt repayment to spend this cash on. If you then look at, on top of this, they are investing like 190 billion. So the operational cash flow is 365, and they have invested 4.3, so it's about 8.5 ROC. Return on gross, or cash flow return on gross investments, KROGI, is about 8.5%. And it's actually almost exactly what we said it would be in 2016, when people were 2 years ago when I was here. So I wouldn't say by coincidence, but still I think we were quite lucky to have this. But and you see it's lower than the national oil companies, because the national oil companies has privileged access to the resources, and they are not able to. So the international oil companies don't generate the same return. So yes, and as indicated in very vague colors here, also this cash flow will be sustained over the next 4 years. So it is a pile of cash to be spent also for international oil companies going forward. And this is, by the way, for a oil price assumption in dollars, which is 85 next year, and then I think like 80 also in 2020, and then down to 75 or something in 2021. So it's oil prices as today for the next 2 years. Of course, we could have scenarios where we see a much bigger decline of the oil price in 2020, which is another story because we get a global oversupply at that time. However, the oversupply will primarily be in the extra heavy oil and sour oil due to the changes in marine shipping, and that you cannot use heavy sulfur-rich oil anymore, and also it will be oversupply of super light oil from the shale. So that's why we think that actually the distillate price, the Brent price, could be still quite robust. So that's another story, but that's part of that we have this fairly flat oil price actually going forward for the next 3 years. So if you look at gross investments in 2008, it was 20%, because we have invested almost 3 trillion since 2008 of this 4.3, so we needed much less cash here to have a high return on investments. So basically, we, as indicated, we don't really get back to the old levels since we have sunk so much capital into the industry. However, accounting-wise, many of the companies has been writing off a lot of the capital as losses. And with that, the capital is reduced on the accounting sheets, and then they can actually achieve higher returns still on the reported return on invested capital. So, but the overall topic is also, as I said before, also if you give an oil man $1, he will spend it, and that's what they are going to do going forward. They have all this cash, they will spend it. So I will try to look also at what they will spend this on. But first, I will try to understand a little bit better how, because the oil price is much lower today than it was in 2011 and 12. So how come we are getting much higher cash out with a much less oil price, with a smaller oil price in dollars? And what has happened? Because 2014 was like a shock that we were hit by something really hard, and now it's 4 years later and we are kind of recovering again. And what has really happened? Why are we recovering? So it's like we are still quite easy to understand this. So let's try to understand what has really happened over the last 4 years. And then we can break this down into the value chain, looking at the exploration, field development, and the operational phase, and try to understand what has happened. Because is this cash, is it because we have just been slicing activity, or just because the oil service companies has lowered their prices, or that we have become more efficient? And we can try to look at this, and if we have been slashing the cost or become more efficient, which part of the value chain have we really improved in? And we can use the numbers from the international oil companies to do this, because these are the companies that are competing most on the international arena and also reallocating their cost according to, they have a broader opportunity space to play on, unlike national oil companies that are very much often have only one set of opportunities in their current country. So as you see, the cost has come down a lot, from 560 to 350. That's the total spendings. $210 billion. That's on this axis, is a different axis. So clearly, the reason is that we have taken down the cost by 210. But what is the source of that cost reduction? Well, here we see this 210 billion, the gap, distributed on the value chain. So from exploration, field development, operations, and drilling and well construction. And this is, as you see, exploration is cut by more than 50%, but greenfield development is cut by almost 70%. So already now we see the biggest source of cash improvement is because we don't develop greenfield anymore. We slashed that with 68%. On operations, we have cut only 18%. And as you soon will see, that is about the same as the service cost reduction. So we don't see any kind of signs of that digitalization or all these buzzwords are actually helping us to be more efficient. What we see is that we just get lower prices from our suppliers, and that's why we spend less on operations. And on drilling we actually see some efficiency improvement, and the cost is down 33%. And this is only for the conventional resources. We will soon look also at the unconventional, the shale resources. But then we can compare this actual cost reduction with what we are producing, meaning that are we per unit, have we become more efficient or not? So this is how much we have been finding. So we have actually been finding approximately as much. This is on this axis. We have been finding about 6 billion barrels every year. So obviously we have become much more efficient in exploration. In greenfield development, we have actually reduced the number of resources, the volume of resources matured for development from 14 billion to 7 or 6 billion, 7 billion barrels, so 50% reduction in the greenfield activity. We have been slightly increasing the production because we had a lot of new fields coming in, and we had reducing the drilling by 25%. So already now we can actually divide the cost by the activity, and we can see the unit price. So some of you will see that immediately. It's a quite easy calculation just to divide those two on each other, and you will see the cost per dollar. Then we are neutralizing the activity reduction effect. And to do that, you see that in terms of unit cost, yes, exploration is down 65%, but greenfield development is also down 35%, and operational cost is down 22%, and drilling is down 35%. So per unit, we have reduced the cost between 20 and 35%, however, much more in exploration. So if the oil service prices has been reduced by 22%, again, the operations are kind of flat in terms of efficiency. But we could have some efficiency gains in greenfield development and in brownfield. And that efficiency gain could be due to high grading, basically that you're just picking the best wells and the best fields to develop. or it could be due to technology improvements or other real efficiency gains. And the oil managers like to brag about that they have been improving the efficiency, but it's not really easy to see, but at least it's a candidate for that about 1/3 of this could be efficiency gains. So we'll look into that soon. Just the similar numbers for shale. This is on the same scale, the actual spending. So you see that the spending on operations has increased, for example. The spending on drilling was down almost 60% and then up again. and in total it's only down 24% just now. So just applying the same metrics, what we have discovered, how much we have matured, how the production has grown, and the drilling, we see the unit cost. So in shale, the unit cost is also down, especially in drilling, 50% down per unit. And this is, of course, the key thing that is a challenge for other onshore activity and other offshore activity, that shale drilling per barrels drilled is 50% reduction. So to get that 1 barrel from Permian or from Bakken, we pay only half the price. And overall, unit cost has gone down from $37 to $21. So if you compare this with this one, unit cost for conventional resources is from 34 to 22. So it was lower than shale, but now it's higher. So basically shale has gone from being the most expensive resource on average to actually be cheaper average on the value chain, on the total unit cost versus versus conventional resources. So this is of course part of the structural shift, that shale is surfacing as a more attractive resource from a cost point of view if you look at the entire value chain. And this is, remember, this is the data for all the international oil companies globally. So this is real data. It's not kind of some kind of forecasting or something. And then, so let's do the interpretation a little bit more. So this is the service price indexes. So basically we have said that for a certain product or a service in 2014, the price was 100. And if you buy exactly the same service or product in 15, 16, 17, and 18, how much you have to pay for that? And as you see, for drilling rigs, this is offshore, you have to pay only less than 50%. But for well service, you have to pay less than 25% less in 2016, but it's slightly increased since 2016. While, for example, subsea has gone down with almost 28% in 2017, slightly increased. But this is from the award year. So in terms of awards, we see a slight trend upwards. For shale, it's been trending upwards since 2016. And for other onshore, it's been more flat since 2016. If you then look at not only the award year, but the execution year of the contract, and we group all the shale and all the offshore service segments, shale was down 26% to 2016, but has increased 14% since then. While offshore in execution has the lowest year ever in 2018. So all companies exposed to offshore, they will probably not see as low prices as they have seen this year going forward. And they haven't seen those low prices in the previous years either. So it's really the bottom. And then we can use this. So we remember that, for example, we had 35% reduction in in field development and in drilling. And we have like 23% on average reduction of the services. So meaning that we have another 10%, 1/3 approximately of the reduction that could not be explained from only activity reduction or only price reduction. And that is efficiency improvement. So for conventional, to get down from 410 to the current spending of 240, we see that most of this is the brown, is the activity reduction. But the activity has increased slightly over the last 2 years. So it's a net of that is activity reduction. But prices has gone down the first 2 years period and the next 2 years period. But the rest is efficiency improvement. And then the analysis is done, is this high grading or is it efficiency improvement? And it's no time to go through the full story on that today. But the key thing is that for field development, it is very much high grading, meaning that you are selecting only to develop the best parts of the fields, only the part that has the lowest break-even from a segment level, and I'll soon comment on that. However, in drilling, it's really real efficiency improvement in terms of that incentives in the contracts has changed from being day rates to be, for example, speed of drilling. And then the mindset of the drilling operation has changed, and people are actually performing higher. So this is so in total, this is about 2/3 is high grading, and 1/3 is real improvement, and that real improvement is in drilling primarily. For shale, we see that activity was as a share of the total activity much higher, 2/3. I mean 1/3. But activity is much faster up again. And the prices went down, but the prices is also up again. And the efficiency went down a lot, but actually now the efficiency has not improved over the last 2 years in shale. So it was, the big improvement was to drill longer wells and to do higher sand injection, then you got the prices down. But still the net effect is that the unit price for drilling has been decreased by 50% as we saw. Okay, so as a result of this improvement, a much larger share of the portfolios of the different companies are currently in the money. And one illustration of this is from the national oil company in Norway, not Equinor, but what is called the SDFI. That is the directly owned resources in Norway from the state, which is about 1/3 of the total resources in Norway. And from their official budget, the national budget in 2016, at $50 break-even, here this is the break-even, and this is the total accumulated, not developed resources. About 1 billion was in the money, or 1.2 billion. Currently, at $50, it's much more, it's almost 50% more, 1.6 that are in the money. So we have seen both resource growth and cost reduction. So basically we are seeing more money in offshore. This is offshore, just to illustrate offshore, that will be in the money to be developed. Also in terms of break-even, we see a huge improvement. For example, for Statoil or Equinor, in 2013, here, the gray, many of the fields had break-even of 60 to 80. Currently, the break-even is between 15 and 22 for many of the key fields. So really a shock improvement. But this is a combined effect of lower service prices, high grading of the development, and also the currency effect. That countries like Norway, but also countries like Russia, is benefiting a lot from the currency, since you have most of the services priced in the local currency. But also for companies that are more exposed to dollars, like ConocoPhillips and Shell, we have seen a cost reduction, a break-even reduction. So very significant. So it's a lot. So the companies have a lot of cash on one hand, and they have very attractive projects on the other hand. So this is very tempting for companies now to start to invest in new fields. And then I will show this cartoon because this is the mindset of the oil manager. So this is the Mr. Oil Co. Top manager. And when the oil price is $30, like it was in 2016, they were only focusing on one thing. I can assure you one thing: I learn our lessons and I keep a firm lid on our costs. While today, at least next year, I don't care how much it costs. We need to produce more now. The analysts will kill us if everyone else is pumping out more, and we're not. And the point is here that also in this situation, the manager is focusing on minimizing break-even. While in this situation, the manager is focusing on maximizing the NPV. And from a value creation point of view, if you want to have a high cash flow return on gross investments, which is the ultimate goal, you know, to have a good investment opportunity for investors, you should do what is on the right-hand side. But if you want to brag about having the lowest break-even projects, you can do like on the left-hand side. But, for example, if you have a field that has 3 segments, one very high permeability, very nice field, one reservoir, and another maybe average, and another quite difficult to produce. So let's say that have break-even 20, 35, and 50. So if you want to brag about minimizing break-even, you can only develop the easy segment, or maybe a combination of the easy and the medium segment, and the break-even will be in the 20s. And you can brag about, oh, I have a field with only $25 break-even. But since still the other segment at 50, it will generate a return on investment at 10%. That's the definition of break-even at $50. And the oil price over the cycle is likely to be 70, 80, 90 over the cycle. Yes, it will be a highs, it will be above 100, but it will also be down to $20, $30, maybe 2 or 3 times during the life cycle. But this is a cyclical industry, as we have talked about before. So, and oil fields will last for at least maybe 30, 40, 50 years. So then I would actually claim that this is actually value destruction, to go for the minimizing break-even. It's much more value creation to actually maximize the NPV. And this, I think this should be the focus, both in the upturns and in the downturns. This is much more value creation. And by the way, if you have this mindset also in the downturn, then you can secure a lot of service prices at very low levels as well, so which absolutely makes sense. So I think here that this is a lesson learned, that the oil market is cyclical, and that you are actually destroying value from being too focused on break-even. But like these charts, companies care about it and they want to brag about it. But as I said, too much focus on this can be value destruction. Okay, so let's then look at how the oil companies then see themselves, what is going to happen, what do they say and what do they see. And here we have included not only the upstream part, but also the midstream and the downstream part for the different oil companies. And we have looked at what is the cash flow break even after dividend, after they paid everything that the shareholders require. And what did they actually have reported. So as I said, this is organic free cash flow after dividend, but thus excluding M&A effects, of course. And it includes midstream, downstream and upstream. And in 2017, the price averaged $55. And this was the cash flow break-even. So for these majors, they were actually cash neutral last year after dividend. So they didn't really have $1 to spend. But companies like OMV, Aker, BP and Repsol, even last year they had quite much cash to spend. But in 2018 and 19, these companies has actually slightly lowered their cash flow break-even after dividend. And the average expectation for price is higher, 71. And next year the average long-term price forecast that is shared is 76, and the cash flow break-even after dividend is even higher. So this just shows that also, seen from what the companies are reporting and implicit in their reporting, they see that they are going to have a lot of cash going forward. So they can either reinvest that or pay that cash back to the shareholders. And then this depends on how they are communicating, because if they are communicating that we want to reduce debt, we want to pay dividend, we want to do balance sheet cleanup, then of course they use this cash to pay back to the investors, rather than if they say we want to invest more. So let's look at how they are communicating. And then I will start to look at 2016, what did they write in their reports. And typically then they have a first, second and third priority. They write in their annual report or in their financial briefings, you know, every quarter, and we can cite them on what they are saying. And basically, I've indicated with the green symbol here. It's actually a light green, you can hardly see it here. That is indicating that they have a growth focus. Or if it's white, it's basically a balance sheet cleanup focus, meaning a contraction focus more to reduce spending and to pay back debt, etc. And in 2016, it was 8 out of these 11 companies were really communicating only about the balance sheet strengthening, not growth. And at Arco, first priority, debt reduction, strengthening balance sheet, improve cost structure. Repsol, divest, dividend growth, debt reduction. Equinor, cost reduction, maintain dividend, share buyback. Eni, dividend growth, strengthening balance sheet, share buyback, etc. I don't need to take all of them, but all of them communicated about being very cautious about spending. Only Lundin, they had that they will grow through exploration. And ConocoPhillips, they also actually communicated that they wanted to invest to sustain production. They were quite much exposed to shale. They're most exposed to shale of all the majors, so they're very early out. If you look at the same communication in 2018, we see that of this, only 5 companies are really focusing still on the dividend and the balance sheet. While the 6 other companies are communicating more and more on growth already this year. And next year we expect that almost all will be on the right hand side. So they will be back on the right hand side of that cartoon as well that I just showed you. That the managers are refocusing from balance sheet to depth, to growth. So let's see where will they spend the growth money. So if we then look at, this is the total spending for 4 different segments of oil companies. It's the majors, the integrated, the independents, and the internationalizing national oil companies. This is Petrobras, Equinor, Gazprom, the Chinese players, etc. All these companies. And they are spending between 2010 and 2014, they spent $700 billion, the majors. And then you see what they spend on. Onshore, shale, oil sands, offshore shelf, offshore midwater, and offshore deepwater. And the main pattern is 2 observations, is that the majors and the integrated, they have really slashed investments a lot, and they are not growing too much the next 5 years either. So they have really been cutting, and they have been really cautious to start new projects. So investments are down by more than 30%, also going forward. However, they are investing more in deep water and more in shale, almost doubling in shale, even the majors. But the integrated are not, and basically if you are not into shale as we speak, it's very, very difficult to get in and to earn money. So even if we can observe that the highest return on gross investments are actually in the shale, that is for the players that are already there. If you have to put a lot of cash on the table to get into shale, and by the way, you don't have an organization that is set up to be successful, it's likely to be value destruction. And one example is BHP, a big Australian mining company that are also big in oil, and they have been in shale, but they sold out completely out of shale. And I just talked to the top manager there. We were sitting together in a panel, and he said, well, we couldn't do shale because we were too bureaucratic. We have an organization that are set up to do mega projects with procedures, etc., budget, allocations, all of that. and then you are successful in doing mega projects. But you're not successful in doing shale, because to be successful in shale, that is day-to-day micromanagement of the local value chain. It's dealing with truck drivers, with the water supply, with chemicals. It's to create competition in the local environment. It is dealing and dealing with the landowners. It's micro management of the business. So a organization that are set up to make big investment decisions, a lot of procedures, will never be successful. So basically this game is not for many of the integrated companies that are much more slow-moving mastodons of companies that will not be successful in shale. So we have to be there to be successful. But independents, they are already there. Devon, Apache, Anadarko, Chesapeake, EQT, etc., all of these companies. And they are the ones that will grow their investments most. So if you are happy to be there, then you can benefit from the super growth that we will see going forward. So they will decrease the focus on offshore, as you see. But Petrobras, Statoil, Equinor, and the Chinese and others, they will actually slightly increase the focus on offshore again. And so the one that will actually grow the most is the internationalizing national oil companies, driven by offshore, and also independents. So then we can also look at which countries will see more spending and which countries will see less spending going forward. So this is for the same group of companies, for all these companies taken together, but no split by the change. If you spend more or less the next 5 years versus this 5 years. And you see all of them, they spend less in 2015 to 19 versus what they did the 5 years before. So basically, what we see is it's a full, of course, comeback, and US is the place in the world that you will see the biggest increase of investments. Russia also some increase, like $40–50 billion, but US is and Canada more than $200 billion. And we have some new countries coming up. Guyana, Brazil, and Mozambique is really the growth countries. So that has not had cash before, but will have cash going forward. So in total, shale will grow more in total resource spending, but offshore is still the largest in total. Meaning that the offshore procurement will grow 11% going forward. These are the different segments of offshore procurement. So basically we will buy more. And how hot will this be market? How much will the prices increase? And we expect that the prices will increase 11%, as I just mentioned. And this is approximately the same as we have had in some of the previous cycles. So this is growth per year in oil service purchases. And this follows the cycles. And it's been really a bad cycle that we have been through with negative growth. But in the degree of hotness, we think that it will not be as hot as it was back in 2005 and 6, but approximately as hot as the last cycle, 2010 to 14. And so it's the third hottest cycle that we are going to face going forward in the last 25 or 30 years. And the oil service companies, they have reduced their revenue with 43%, and they have taken out 500,000 people, from 1.3 million people to 820,000 people. So this is the top 450 companies, directly from GCube. So one of the databases we have that you can all subscribe to, and this is the top 10. But then you see all the revenues and everything from all these companies, and also the number of employees. And these people, 500,000 people, we have to recruit back to the industry for its next growth cycle. And they will not get back if they don't get a salary that is higher than what they had when they left, when they were kicked out. And that is going to drive cost inflation. And then, in this macro picture, I will then illustrate what is happening on the player landscape. And it's a map behind here that you don't really see, but this is, yeah, you can hardly see. This is Norway, this is the North Sea, this is the Americas, and this is Asia. So this is focusing on the North Sea. And what we see is that American companies are going back to America. And majors, they exit as operators. All these companies here have exited partly or fully their operatorship. And utilities, they are going back. Basically, oil and gas is out of fashion for utilities. Renewables is fashion. So basically, they are selling off oil and gas and becoming renewable companies, all these utilities. The companies that are coming in is private equity players, and they're actually the one that has invested the most. And that's very good, because we get new, fresh capital with people that are much more aggressive in terms of drilling up new targets, etc. Russian companies are coming into the North Sea, Asian companies, and also downstream and chemical companies are entering. So we get a new player landscape. The majors are out, producing from 900,000 down to only 300,000 in 2025, while the smaller new companies are having a similar growth. And as I said, for example, Exxon, they had 16 well targets in one of the fields called the Balder that they were never approved for development from Houston. When they exited and a private equity player came in, they are going to drill all these targets. So it's very good to get in smaller players to boost production. And I think actually the same would apply for Russia. If you were able to make more pluralism in the sector, you would have much faster growth in the 2020s. Then the last point, should we do exploration? Will they use all this cash to do more exploration? And if you look at the global exploration budgets, it's down 65%, from 150 to only 60. And if you look at the global, this is the global production of oil and gas to 2060. This is the global discoveries of conventional resources. So in one way we could panic. We are only finding 20% of what we are producing. But this is conventional resources. So should we panic? Is it a problem that we're only finding 20%? So let's look at that. Basically, we have already found 1.6 trillion barrels. And a lot of this is the new shale, the new red part. So we need only to find 0.3 trillion barrels going forward. And actually, shale can take almost 75% of this. So due to shale, we don't need to find so much new conventional resources. So we will actually, so my point is, you don't need to panic globally, even if you haven't found, even if the recovery reserve replacement ratios are quite low. So this is what we have found, this is what we have been producing, and this is what we're going to produce for the next 18 years, 2 times here. So, so I think, well, let me take this as a last slide. So probably shale has the potential to grow to 20 million barrels in 2025. It's even higher than what I have shared with you before. But still it's room for offshore, for the right players. Not all players can be in shale. And so I think I can end there. So thank you.